Hello folks, good morning. Welcome to our Q1 result update series at GSR Invest. In this episode, we'll be talking about a business that personally I'm not too interested from a pure investment point of view, and we'll speak about reasons for that later. But the reason why we track that is because it serves as a good gauge about broader consumer sentiment and consumer demand plus financial balance sheet strength in the middle to upper middle income segments as such, right? The business that we're talking about is SBI Cards, and before we kind of dive into their results, just a brief overview of why we don't like sort of a business like this, right? So whenever we are investing in any of the financials, personally I have a very strong bias towards secured sort of lenders, primarily on say the home and gold side. The reason why we don't like kind of unsecured lenders too much is through cycle their credit costs tend to be quite high, right? And even within that pack, uh, players like SBI Cards are even worse on that spectrum, right? So their credit costs have been north of 6% for the last few quarters now, and in the recent quarters they've been as high as say 9% plus or so, right? So from an investor standpoint, it doesn't really make much sense to invest in a business with uh, such poor kind of asset quality over a prolonged period of time, right? A few quarters, a few cycle you can understand. Over a very prolonged period of time, if you consistently have very bad quality, doesn't make too much sense from an investment point of view, right? That being said, this is one business that we continue to kind of track quarter to quarter, because broadly we get a good idea of two things, right? One, we get a good idea of how bullish broadly consumer is, right? And one way to kind of gauge is to see how spending in the consumer segment is growing, right? Typically, if people are a bit worried about the future, if they are a bit concerned about uh, how they'll be able to make ends meet, typically consumption goes down a bit, and typically when they're a bit more optimistic about the future, you'll see consumption go up a bit, right? And that is kind of data that we get in this business. Important to understand. So SBI Cards is now say around 19-20% of market share in terms of cards in force, around 17-18% market share in terms of transactions and spends as well, right? So a substantial part of the market, so serves as a reasonably good proxy of middle urban, middle upper middle sort of segments as such, right? And one trend that we've seen over in Q1 this year is that broadly retail spends have grown quite well, right? So for context, retail spends grew 15% plus in this quarter, and overall spends for the SBI cards category, including the corporate segment, grew at 21%, right? So broadly very strong growth within the cards business, and more importantly, more of the spend, the faster growth in spends is coming to the discretionary categories, right? So what SBI cards also does is gives you a split about how much is going towards your basic groceries and kind of essentials as such, then slightly more discretionary, which is your consumer durables, etc., and then completely discretionary, which is your travel spends, hotel and restaurant spends, and stuff like that, right? And what we're seeing is the spends in the latter two buckets are kind of growing quite fast, right? Which is generally a good trend, that at least the upper and upper middle segments are kind of doing reasonably well as such, right? Why the split is also important to track is because periods of down cycle where people say employment is hurt but they still have a card, you will see increase in spends, but the spends will be more on the essential side of things, right? So if you see a spike there, that is actually a cause of concern. But a 21% growth in total spends, with spends in the latter two buckets growing faster, is actually a broadly positive sign as such, right? The other major factor that we want to see is typically people paying a bit on time as well, right? And the way we kind of see it is multiple kind of factors, but broadly tracking receivable growth and whether that is broadly on track is a relatively good sign, right? And if you look at how receivable growth for the business has grown, it's grown just 7% odd or so, right? For context, the cards that SBI has have actually grown 10% in the same period. So the receivables per card have actually come down, right? So in an environment where broadly your spends are growing quite well. Spends in the more discretionary segments are growing even better, and your receivables per card is coming down, is a uh, looks like a relatively good environment for your middle and upper middle sort of customers, right? And obviously, when these sorts of customers do better, there'll be parts of the market where growth will be better, right? So these guys will spend more on stuff like jewelry, on stuff like travel, on restaurants, and all of these categories, right? So the more premium discretionary sort of categories will tend to do better in this sort of an environment, and tracking SBI cards seems like a good way to gauge that, right? Gauge how that particular segment is doing as such, right? So that's a brief overview of the business and kind of insights that we get from it. Obviously, from my research, for my research clients, this is a strict no go. I'm not too interested in businesses like these. But again, something that I do track quarter to quarter because there are insights that can help other parts of my investing, right? So obviously, when you're finding an opportunity, you do not have just a unique focus. You can get learnings from a company that you don't want to invest in, apply it for other sectors, etc. Right? Which something like this is quite helpful, right? I hope this session added value. If it did, please hit the like button. That helps YouTube share our video with more folks and helps us grow. Thank you so much. Thank you for your time.